What's going on, everybody? Hope everybody is doing well. If you have been tapped into the Trade for Yourself podcast, you know that I haven't been doing that many lives as of late. I've been shifting to pre-recorded, but that's a strategy to try to get my content out to more people. Please bear with me if you see me kind of a little jittery a little bit because I haven't done a live video in a while, but since we had the Super Bowl today, i.e., we had a big interest rate decision today, I thought that it would be a good idea for me to go live right after that decision happens so we can discuss it and so I can add the maximum amount of value to you all this week. And so I don't want to hold anybody else's time. So if you're new here, welcome back to another episode of the Trade for Yourself podcast, where my mission here is still very simple. I want to help you learn how to trade and invest in the stock market for yourself. So I want you to please like this video, please subscribe, hit that notification bell because I want you to be in the know every time I drop an episode. Okay, look, please note anything I discuss in this episode is not financial advice. And I really want you to do your own research before you invest into any stock. And so today we had the interest rate decision from the Federal Reserve, and the Federal Reserve raised interest rates by 25 basis points. And when that happened, and after Jerome Powell's press conference, and we look at where the market closed, at the end of the day, we can look at the market and say Jerome Powell really sent the stock market down again. Now, there were a lot of things that he said during this specific meeting, and I'm going to break that down, and then we're also going to go to the charts. But at the end of the day, this specific meeting that we saw, how stocks reacted, how the stock market looks right now, how the S&P 500 looks right now, at the end of the day, it boils down to one simple thing. I'm going to break that down at the end. Okay, I'm going to break that down at the end. But let me go ahead. Let me share my screen here. I don't want to be here long. I really want to hit the high points, and I want to give you guys what you need immediately. All right, immediately, so you know exactly what you need to be doing. Okay, so the Fed hikes rates by a quarter percentage point, which is 25 basis points, and it indicates that the increases are near an end. All right, so the Federal Reserve on Wednesday enacted a quarter percentage point rate increase, expressing caution about the recent banking crisis and indicating that hikes are nearing an end. Along with this ninth hike since March 2022, the rate-setting Federal Open Market Committee, which I will now state as FOMC, noted that future increases are not assured and will depend largely on incoming data. The committee will closely monitor incoming information and assess the implications for monetary policy, the FOMC's post-meeting statement said. The committee anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Now, this is different from what they have been saying the previous 9 times they did this. When the Fed comes out, they'll tell you about policy and what they believe will be appropriate moving forward. Jerome Powell, over the last 12 months, has consistently said that he believes that ongoing rate hikes will be appropriate moving forward. But now the narrative and the way that they are saying this is shifting from the committee anticipates that some additional policy firming may be appropriate. So I believe that we are getting closer to the end of the rate hikes at the end of the day. That wording is a departure from previous statements, which indicated ongoing increases would be appropriate to bring down inflation, like I just said. While comments Fed Chair Jerome Powell made during a press conference were taken to mean that the central bank may be nearing the end of its rate hiking cycle, he qualified that the inflation fight isn't over. And if we look at the federal funds target rate right here, right now we're between 4.75 to 5%. And that's the largest that we have been since 2007. Okay. The process of getting back down to 2% has a long way to go and is likely to be bumpy, the central bank leader said. Also, Powell acknowledged that the recent events in the banking system were likely to result in tighter credit conditions, and that was likely why the central bank's tone had softened. Still, he said that despite market pricing to the contrary, rate cuts are not in our base case for the remainder of 2023. Stocks initially rose after the Fed's decision, but slumped following Powell's remarks. Now, what does he mean when he says that market pricing is to the contrary in terms of rate cuts are not our base case? What he means is he's pretty much referring to treasury yields, the 2-year yield, the 5-year yield, the 10-year yield. All of the treasury yields have came down substantially since the Silicon Valley Bank collapse and the signature bank takeover by the Federal Reserve, essentially. And so what he's saying is that, yes, the 2-year note may be below 4%, and that may indicate that rate cuts are going to happen in this particular year, but he's saying that him and the committee don't see any rate cuts happening. So the U.S. banking system is sound and resilient, the committee said in its prepared statement. Recent developments are likely to result in tighter credit conditions for households and businesses and to weigh on economic activity, hiring, and inflation. The extent of these effects is uncertain. The committee remains highly attentive to inflation risk. During the news conference, Powell said the FOMC considered a pause in rate hikes in light of the banking crisis, but ultimately unanimously approved the decision to raise rates due to intermediate data on inflation and the strength of the labor market. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so. That will bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So what we have to understand is that the recent developments with the banks actually did have the Fed pausing a little bit, thinking about, hey, have we done too much to the banking system, and have we caused monetary policy conditions to pretty much tighten too much? They had to think about that because of what is going on. Now, the increase takes the benchmark federal funds rate to a target range between 4.75% to 5%. The rate sets what banks charge each other for overnight lending, but feeds through to a multitude of consumer debt like mortgages, auto loans, and credit cards. The projections released along with the rate decisions point to a peak rate of 5.1%, unchanged from the last estimate in December, and indicative that a majority of officials expect only one more rate hike ahead, because that peak rate 5.1% is pretty much the terminal rate that is between that's pretty much between that 25 basis point range. So pretty much right now, the Fed is saying that they will probably only raise interest rates one more time. So one last 25 basis point hike. That will put the federal funds rate to 5% to 5.25%. Now, data released along with the statement shows that 7 of the 18 Fed officials who submitted estimates for the dot plot see rates going higher than the 5.1% terminal rate. So you have to take that into consideration as well. The next 2 years worth of projections also showed considerable disagreement among members, reflected in a wide dispersion among the dots. Still, the median of the estimates point to a 0.8 percentage point reduction in rates in 2024 and 1.2 percentage points worth of cuts in 2025. The statement eliminated all references to the impact of Russia's invasion of Ukraine. Markets have been closely watching the decision, which came with a higher degree of uncertainty than is typical for the Fed move. So if we look at these dot plots and these projections, I don't want us to hold on to these projections, to marry these projections, to say these projections are permanent, because I honestly don't think that we need to be thinking too much about what the Fed is doing at this specific point, because the Fed has done so much tightening to this point. And I believe that we're pretty much getting very, very close to the end, because the Fed just can't tighten into a recession. Now, the move that they have made may eventually cause a recession down the line, and we may eventually see one because of the moves that they have made. But at the end of the day, it's really getting to the point to where we shouldn't be concerned about the Fed so much if we're trying to build wealth. If we're really truly trying to build wealth, if we're really truly about trying to make money in the stock market, we need to pay attention to what the Fed is doing, but we don't need to be consumed with what the Fed is doing. That's my early that's my early opinion on what I want to get to at the end of the episode. Now, earlier this month, Powell had indicated the central bank may have to take a more aggressive path to tame inflation, but a fast-moving banking crisis thwarted any notion of a more hawkish move and contributed to general market sentiment that the Fed will be cutting rates before the year comes to a close. And I'm glad that they are not doing the more hawkish move, because before SVB collapsed, there were talks that the Fed might raise by 50 basis points. And I believe that would have been totally overkill and the market would have came down significantly as a result. Now, estimates released Wednesday of where FOMC members see rates, inflation, unemployment, and gross domestic product underscore the uncertainty for the policy path. And so now what we're about to get into the summary of economic projections. And the Fed doesn't give a summary of economic projections at every single Fed meeting, but they give them periodically throughout the year. So officials have tweaked their economic projections. They slightly increased their expectations for inflation with a 3.3% rate peg for this year, compared with a 3.1% in December. Unemployment was lowered at a notch to 4.5%, while the outlook for GDP nudged down to 0.4%. The estimates for the next 2 years were little changed, except the GDP projection for 2024 came down to 1.2% from 1.6% in December. The forecast come amid a volatile backdrop. So pretty much that kind of goes into what Powell was saying in terms of him believing that, this banking situation may cause tighter credit conditions. With tighter credit conditions, you also may have to say, well, economic activity may not be as good as what we thought it was. That's going to tighten things and slow the economy down to a certain degree. We don't know how to necessarily measure that until everything pretty much happens. Now, despite the banking turmoil and volatile expectations around monetary policy, markets have held their ground. The Dow Jones is up some 2% over the past week. It's not up that much now, though the 10-year Treasury yield has risen about 20 basis points, or about 0.2 percentage points during the same period. While late 2022 data had pointed to some softening in inflation, recent reports have been less encouraging. So we're talking about the Personal Consumption Expenditures Price Index, a favorite inflation gauge for the Fed, rose 0.6% in January and was up 5.4% from a year ago, 4.7% when stripping out food and energy, and that's well above the central bank's 2% target. And the data prompted Powell on March 7th to warn that interest rates likely would rise more than expected. And that's the thing about inflation that I really want people to talk about. What I really want to talk about in terms of inflation, I just feel that people have an unrealistic expectation in terms of inflation. Inflation is going to continue to increase month over month, year over year. It's all about the rate of inflation, right? The rate of inflation is what we should be worried about, and we should want the rate of inflation to come down. We don't want inflation to be increasing so much on us month over month, year over year, but inflation is going to increase. At the end of the day, inflation is just ingrained into the fabric of this economy. And so we have to just understand that. Okay, we understand that. We know that. How is the market going to price that? I don't know. We have to look at technical analysis and see how they're going to price it, right? But the banking issues have complicated the decision-making calculus, as the Fed's pace of tightening has contributed to liquidity problems. Closures of Silicon Valley Bank and the Signature Bank and the capital issues at Credit Suisse and First Republic have raised concerns about the state of the industry. While big banks are considered well-capitalized, smaller institutions have faced liquidity crunches due to the rapid rising interest rates that have made otherwise safe long-term investments lose value. Silicon Valley, for instance, had to sell bonds at a loss, triggering a crisis of confidence. The Fed and other regulators stepped in with emergency measures that seem to have stemmed immediate funding concerns, but worries linger over how deep the damage is among regional banks. You know what I mean? And so when we think about this, we have to understand that the big banks are definitely going to have more money than the smaller banks, right? Your JP Morgans, your Goldman Sachs, your Citigroups, your Bank of Americas, your Morgan Stanleys, Bank of America, like they're fine. Like those banks are fine. We actually have seen an increase in depositors at a JP Morgan and Chase because of what is going on with the regional banks. And so we just need to keep that in mind. And so since we are nearing the end of March and going into the beginning of April, guess what? We're getting back into earnings season again. With that being said, since we're going back into earnings season, what we need to understand is that we're going to hear from the banks first. And so the banks are going to provide a lot of color about their pretty much, their loan loss reserves and what they have going on at these particular banks. Now, to close out this article, at the same, recession concerns persist as the rate increases work their way through the economic plumbing. An indicator that the New York Fed produces using the spread between the 3-month and the 10-year treasuries put the chance of a contraction in the next 12 months at about 55% as of the end of February. The yield curve inversion has increased since then. However, the Atlanta Fed's GDP tracker puts first quarter growth at 3.2%. Consumers continue to spend, though credit card usage is on the rise, and unemployment rate was at 3.6%, while payroll growth has been brisk. So what we have to understand is that there's so many things that we just don't know. There's so many risks out there that we have. There's so many things that we just don't know. But this is not going to stop us from investing into the stock market from a long-term perspective, because there's no need for us to worry about it. There's always going to be risks that are going to continue to come up. Like a banking crisis was not a risk that I saw in any 2023 stock market projections when I was looking at that stuff late last year, early this year. I didn't see a banking crisis in the projections, right? But theoretically, that was a risk that we should have been thinking about. Okay, now it's a risk. It is a risk that is pretty much in the forefront, right? There's another risk that may happen a year down the line, 2 years down the line, 3 years down the line, but we shouldn't be worried about it, because we have to have a long-term perspective, a long-term standpoint, a long-term frame of reference in order for us to actually make money and actually build wealth in this particular market, regardless of what you are doing at the end of the day. Now, what I want to do is I want to share Thinkorswim here, because I haven't looked at the charts in a while, because like I told you all, I've been doing a lot of pre-recorded content and I haven't been looking at the charts in a while. However, I do want to kind of go back to something that I had said, in previous episodes. Now, the one thing I want to tell you is that this is the S&P 500, right? This is SPX, and this is a daily chart. And as we can see, I have a line drawn from the stock market's all-time high, and we have a trend line. And the stock market has been trending, right? It's pretty much been trending on that downtrend. But still, we're nowhere near this low that we made in October. Like we're still nowhere near it, right? And if we look at it, on this particular trend line, we have, since we broke above this trend line, we have came down briefly and came back up. And I'm going to zoom in here a little bit closely for us. As we can see, we had a red day in the market. And so now it's a possibility that we may be able to retest this 3808.86 level, right? Because we see that this could potentially be some support here. We see some trading around here, so some consolidating around this particular level. This we can see is a key level because there's a gap between this day and the next day. So we're pretty much in an area to where we could see maybe a bounce, maybe we continue to bleed down. I don't particularly know, but the market at the end of the day did not like what it heard towards the end of the day. And I'm going to show you all what had happened, okay, in the market today. right? I'm gonna show you all what happened. And so this is a 15-minute chart. This is a short-term chart. And so we can see the stock market was trading above 4,000 today. Like it had peaked a little bit, but then it started to come down, and it was just kind of ranging. But again, this is a 15-minute chart. So every single one of these bars that we see represents a 15-minute time period. We see that the last 30 minutes of the stock market, right? We bled down. Like all of the volume came into the stock market to send the market down in the last 30 minutes of the stock market. And so this is kind of showing us that the market really didn't like what it heard, and we can continue to see more bleeding tomorrow, more bleeding Friday. Like we really don't know, but at the end of the day, we just have to wait and see, right? We just have to wait and see what happens at the end of the day, because the market over the next few days and weeks is going to kind of decide, how it feels about what the Fed does. We're going to hear more things about the banking crisis, all things of that nature. But if we just sit back and just take a look at these charts, right, and we just look at what has happened, we were at our all-time high. We came down, made our current bear market cycle low. We made our current bear market cycle low, and we haven't been anywhere near it since. We may come down and retest it, we may not. But if you just look at this, right, I have 4,200 here outlined, okay? 4,200 is a major level of resistance for this market, right? Major level of resistance. 4,300 is 4,330 is a level of resistance I would say would be an even more significant level of resistance, because we haven't seen 4,300 since August of last year. So if we were to get past 4,200, 4,300 will be an even more significant level of resistance. We hit 4,200, but we pretty much bounced off pretty significantly, and we haven't been sniffing it since then. And this sell-off that we had today kind of tells me we'll probably sell off again and probably retest this level, maybe hold the trend line, maybe not, maybe break down below. I don't know what it's necessarily going to do. But if we just look at it, the market's just been ranging. It's been ranging sideways, consolidation. I look at this and I say a lot of people have been accumulating shares just between this particular point. They've been accumulating shares in SPY, accumulating shares in QQQ, accumulating shares in certain stocks that they want to hold over the long term. And so what we got to understand is that the market is just going to be consolidating, I feel, for the remainder of this year, maybe next year. I don't know what the market is going to do, right? But we have to understand that we need to be building positions now. We need to be building positions. We need to be accumulating these shares. And that's exactly what I want us to do. And so before I close this out, I just want to go back to what I said previously earlier in the episode, when I said that everything that we've seen with the Fed, everything that we see with the market that's going on right now, right, it all boils down to one thing. The one thing that it boils down to is that if you really want to make money in the stock market, you got to be into it for the long term, and you got to be focused on accumulation, like accumulating a position over the long term, right? So if you are a person that has not invested into the stock market yet, what I want you to do is to start investing now. Start investing. Put your money into the ticker symbol SPY, the S&P 500, and consistently put money into it every single month, because we have to build our positions now. We can't wait until theoretical crises happen and then decide to say, hey, I'm going to put my money to work at this time, because there's been plenty of opportunities for us to do that along the way. Now, if you're just getting started, you have to think about this from a long-term perspective. Think about this from a long-term game and understand that I'm trying to build wealth over time. If you're a person that's trying to make money right now, you want to be able to make money every single day, every single week, every single month, and you want to make money from a short-term time span, then maybe you need to learn how to trade. Maybe you need to tap in to other people, invest into yourself so you can learn how to trade, right? Like if I put out information about trading, I'm going to put it out there. I'm going to let you all know what I'm actually doing, okay? Like tap in, learn for yourself, learn the game and see what you need to do, right? Like this is a time for us to be putting our money to work heavily putting our money to work, heavy accumulation, right? Building wealth over time, right? Taking risk, like establishing things that can bring us cash flow so we can then put more money into the market and figure out more ways to make money in the market and see how the money actually works, right? See how the market actually works if you are new to this. So I'm telling you, we've been talking a lot about the Fed. We've just been talking about the Fed, but it's really truly for me getting to a point to where what the Fed continues to say from now until the end of the year, and what the Fed continues to say is it starting to become a non-factor, because at the end of the day, if Jerome Powell wants to send the market down, that's an opportunity for you to make some money if you're trading, for you to make some money if you're investing. We have to understand that now is the time. We have to understand that there is a sense of urgency. There's a sense of urgency for us to be investing. There's a sense of urgency for us to be trying to make money in the stock market so we can build wealth, because the bull market, the new bull market, when they announce it to you, when the media announces the new bull market to you, at that point, it's going to be too late. And you're going to be wishing and asking yourself, why didn't I start right then? As always, I appreciate you all again for tapping into another episode of the Trade for Yourself podcast. This was a special live episode. So again, please like, please subscribe. Make sure you hit that notification bell so you can be in the know every single time I drop an episode. Please reach out to me. Please ask me questions. I want to be a resource to you all, and I want to help you all make money, build wealth in the stock market, and really learn how to trade for yourself. As always, remember this. Don't pay for it. Trade for it. I'm going to tap in with y'all next week.